Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on March 31st. So ending the week with the end of the month and the end of the quarter. My name is Ian Saunders, and I'm joined here as well by David Clark. David, there's certainly been no shortage of movement, no shortage of stuff to talk about over the course of the month of March. I know it's a pretty popular season for basketball fans, but the markets have definitely seen their fair share of madness, I would say, over the course of the past several weeks. Definitely been some pretty interesting movement.
Could agree.
Yeah,
could agree with that for sure.
Yeah, and and it's kind of interesting too because we got one of the craziest March Madness basketball tournaments that we've had in kind of recent memory. I mean, this is the first time in a while, maybe ever. I'm not a huge basketball stats fan, but no 1, 2, or 3 seeds in the Final Four. I mean, there's just a lot of interesting movement that we're seeing there, and we've seen a lot of interesting movement in the markets too, kind of culminating with some of the movement that we're seeing at this Thursday afternoon at the time of this recording. We're looking at an S&P 500 that's up a little bit for the day. The S&P 500 is showing pretty decent returns so far for the month of March, up 1.45%. So not shockingly great returns, but positive returns nonetheless, right? It's kind of good to see it in the black or in the positive territory there. Past 7 days have been especially improvement of up over 2% over the past week, again, through market movement through Wednesday there. But that's all led the S&P to tick back up into a overall positive trend on its default chart. So that default 20-point chart, it's giving a second consecutive buy signal. You have a buy signal early this month at the 39.40 level, and then ticking a little bit higher with movement today, crossing above that 40.40 point to mark a second consecutive buy signal just above the midpoint on its trading band, and also putting it back in a positive trend. And David, I know there's just kind of looking at that 20-point chart, it's flipped trends a few times over the course of the past 6 months or so, right? So we do see this kind of consolidated trading range.
Right. So it's still within that consolidated trading range, and even had that question asked earlier. We're seeing it break out above 4,000 even earlier this week, and it still said, well, it's still in this range that we've seen it in for roughly 6 months. And ultimately, we've still got a little bit of resistance to overhead, leading up to our rally high from February there at 41.80 on the 20-point per box chart. But that's sort of an absolute kind of near-term improvement, and we've seen sort of the indicators follow suit with that as well, because some of the shorter-term indicators, such as the 10-week for the NYSE as well as the NYSE high-low, reversed up following yesterday's action. So kind of those two things with the trend reversals, seeing some of the short-term indicators move back into X's out of what we consider in most cases is washed out territory. We're now getting some type of positive action out of many of the U.S. equity indexes, especially when February was a bit of a negative one. So nice to see that change of pace for the month of March, if you will.
Yeah, absolutely. I mean, the broader domestic equity space, I mean, I mentioned we're positive returns for the S&P for the month of March, but I mean, it certainly didn't feel that way 2 weeks into the month of March, right? When we had a lot of, I mean, all the bank potential crisis, everyone didn't know if that was going to spread a contagion. And I mean, we're going to end the month in a positive territory, which is kind of shocking. I probably wouldn't have necessarily suspected that if we were looking at it a couple of weeks ago. But we did see some relative weakness throughout the month of March for the broader domestic equity space, and in many of the rankings that we have, or many of the broader rankings, I should say, like the Dolly asset class ranking. We touched on last week that the domestic equities asset class fell down in the 4th position out of the 6 areas examined, with commodities ticking up and overtaking domestic equities there. So those 2 areas were sitting really close from a relative strength buy signal perspective. And we saw a little bit more weakness from the domestic equity space, kind of bringing it down into that 4th position. And the strength in commodities really kind of been focused on metals, industrial metals, precious metals. We'll get into more of that in maybe a minute, but we haven't seen enough of this near-term improvement over the past week or two, kind of dictating a much broader relative strength perspective, David. But we have seen some interesting movement if we look at some of the other relative rankings that maybe tend to move a little bit quicker on the platform.
Right. Looking at some of the asset class group scores rankings, we see a lot of that action. We've seen this page, it saw technology moving that score above 3 before we saw that action transpire over into Dolly moving up into second there. We had sort of predicated what we saw, or preceded really, rather, what we saw transpire in Dolly. And the asset class group scores page is going to be a more sensitive tool. It uses our fund scoring system to evaluate 134 groups ultimately in an effort to build a ranking system, finding the leadership, knowing where we should avoid. And, even with a lot of this past volatility that we've seen that core percentile rank continue to tick up a little bit, showing some improvement, as well as the money market percentile rank somewhat ticking down here. So really seeing a lot of groups improve overall. Looking at, the group scores page right now and just looking at that sector view, you mentioned earlier, precious metals kind of having some little bit of a dip in the commodities and, evaluating group scores here. It brings in equities as well. So we've seen some rebound out of sort of those metals mining stocks as well, and basic materials, but precious metals leading the group scores there on the sector view. I've seen a rebound out of energy a little bit, kind of a near-term rally out of it, looking at MLPs, but still not really significant enough to bring it out of the doldrums. But MLPs is really the only glimmering piece in terms of energy there. But technologies continue to be the one we've watched, and it had kind of creeped up there and kind of sits right with that core percentile rank, that S&P 500 index funds group right now. And we're seeing a lot more sectors sort of join the party, if you will, in terms of moving back above or maintaining that score back above 3, because we also have industrials, transportation, consumer cyclical and non-cyclical, which is interesting. Continue to see those two somewhat opposite sectors kind of jockey for position right now on the group scores page, but also have infrastructure and basic materials. Really the only thing we're seeing right now, scoring below that are some tech things, but we've also seen a lot of score improvement out of that. So when we look at those areas where we've seen a lot of that score improvement, organizing that score or sector view by score direction, we see precious metals, technology, and then internet. So, seeing that view of precious metals as well as technology, not only on the near-term improvement part, but seeing some of that leadership as well within the U.S. sectors right now on the group scores page.
Yeah, and I think it's even maybe perhaps more interesting if you take it from the sectors and you broaden it out to the all groups and then you sort it by direction. I mean, just the top 5, top 6, 7 areas that we're looking at from that broader directional sort, just trying to show the different focuses that are showing improvement across the broader marketplace, right? I mean, you have Europe as the highest score direction of anywhere on the system, ranks 3rd out of every 134 groups on the system with this 4.13 score direction north of 3. You have Europe and then precious metals, technology, Pacific-based and Japan, non-US and internet. I mean, just a lot of different areas that are showing movement, right? I mean, it's not just one area within international equities. It's generally more geared toward more improvement from the developed market areas, as you see with Europe, as you see with Japan. But then you have more growth, domestic areas, technology, internet, global, international, developed growth, or another kind of area that's shown some strength in there. And then precious metals coming from that commodity side, right? I mean, it's just a lot of different kind of areas within different asset classes that really kind of seem to be drawing a lot of the movement for the broader asset class as a whole that we see in some of the other rankings. The money market percentile rank was one thing that you mentioned there, David, that we did see tick up higher again back in mid-March, right? Back 2 weeks ago, back on March 15th. I mean, that money market percentile reading was back up almost to 75%, 74.65%, which is north of the threshold that's going to lead it to come into some of the models if it remained there at the end of the month. So some of the fund score method models, if it's money markets north of 70%, then those models will move into a cash position. Luckily, over the next few weeks, or hopefully, luckily, I guess we'll see over the course of the next few weeks. Luckily, that score has retracted pretty solidly, as you see. I mean, it's now down back in the lower third of the group scores ranking, whereas we've seen that U.S. equity core percent continue to climb a bit higher. So we've seen kind of a broad improvement from different areas, but not necessarily improvement across the board. However, there has been some notable improvement. David, I know that we were touching on some of the different asset classes. I mean, one asset class that we haven't really seen any strength in or much change in from a relative strength perspective in the Dolly tool is the fixed income area. However, right, if we're looking at the fixed income area and the group scores, you can begin to see that some of those areas are starting to tick up a little bit higher. You just touched on them. You touched on a few of them there. Most of the broader fixed income, or a lot of the movement we've seen within or above that U.S. money market has been a lot of those fixed income areas kind of ticking back above, at least on a near-term basis, moving back above that 3.0 score threshold, like you said there.
Well, and looking back to, rewinding back to the end of February, and if you look at that snapshot of sort of the fixed income view, if you will, on the group scores page, there were only 3 fixed income groups that are scoring above the score of 3. And they were floating rate, inverse fixed income, and then all global income. So really kind of an interesting mix. Floating rate, not too surprising. We've seen that be sort of the group that's maintained its score strength within fixed income. Obviously, inverse fixed income has been there for periods of time, if you will. But when we roll our calendars to today, we now have 22 total groups from the fixed income area and the fixed income asset class that are scoring above 3 right now. Many of them also have moved back above, as you noted, back above U.S. money market. So, on a relative and trending basis, saying they're better off than cash, if you will, when we look at that score perspective. And even today, you do still see floating rate up there, but you also now have a lot of municipal groups up there as well. Single state bond municipals being sort of that second high scoring group within fixed income. But you've got some, global government and well as mortgage backed and even short duration. So it's really a mix, if you will, of looking at these groups that have improved above that score of 3, especially over the past month, and almost doing it somewhat quietly, if you will, maybe not, depending on how you define recent market action, but it's sort of fallen down the list of things you're reading about when we're looking at a lot of the recent banking headlines, what the Fed's talking about. Improvement in fixed income probably wasn't something folks were expecting, but we're seeing that, and we're seeing that occur on the group scores page. Not quite on Dolly yet, as you noted, but it's hard to ignore going from 3 groups to 22 groups scoring above the score of 3 within a matter of a month's time for any particular asset class, not much less fixed income.
Yeah, and when you're looking at the broader asset class picture, right? I mean, I think one of the more interesting things, at least I'm continuing to monitor here, is we have 85 groups that are scoring above that score of 3. So 85 of 134 different groups scoring north of that 3.0 line. Only 14 of those are above the 3.5 line. So that's 74 groups are between 3.0 and 3.5. That's a lot of groups in a very, very tight range. More than half of the group scores page is within half a score point of one another within that tight range, right? So we've seen a lot of movement over the course of the past 4 weeks. I mean, we would expect that movement, we might continue to see some further movement over the next several weeks that really kind of shake out some of those scores, hopefully some moving higher. Hopefully those kind of growth areas continue to tick higher up in the score rankings. But that's definitely going to be a pretty interesting area to watch. We're probably not going to see 74 groups in that half a point score range a month from now. So it'll be pretty interesting.
Not for too long.
Right. It'll be pretty interesting to see how those kind of shake out, what moves higher, what moves lower from there. Definitely something we'll be continuing to monitor there throughout the month of April. But with that, David, I think that kind of wraps up at least a lot of what we were looking to touch on from a broader perspective. I know we hit on a lot of different areas today. We probably could have dive deeper into some areas, but that's why we have other podcasts, right? Mm-hmm. So, I mean, with that, I think that does kind of wrap us up for this week, wrap us up for the month of March, and wrap us up for the first quarter of 2023. So, David, thanks for coming on here. Thanks to everyone for tuning in this week, and we'll be back to talk to you again next week for the first podcast in the month of April.